The corporate rent trap. Why Wall Street is buying up all the starter homes and why you'll pay the price. Your rent's up 22%, your paycheck isn't, and the landlord isn't a person anymore, it's a logo. This year alone, families paid hundreds more to corporate landlords than to small owners, same bedrooms, more fees. Rents didn't just happen. They were engineered into a profit machine. We're at the highest rent-to-income levels in decades, and waiting 6 months likely means paying more for less. Today, you'll see the playbook, the machinery behind it, and how to defend your wallet. To understand why your starter home became a spreadsheet, and why your lease reads like a bond prospectus, we need to go back to the last crisis. The spark, how starter homes became an asset class. The spark didn't look like a plan at first. In 2009, cul-de-sacs were quiet and foreclosure notices fluttered on doors. Families packed boxes. Meanwhile, another kind of visitor showed up, funds with cash. They weren't shopping, they were sweeping. Bulk purchases turned scattered houses into rows in a model. Single-family homes, once a neighbor-to-neighbor business, became inventory. Cheap money made it irresistible. With near-zero interest rates and central banks flooding markets, investors hunted for yield that didn't wobble with every headline. A rent check looked steady. If you could buy a foreclosed home for half its peak, fix it, and rent it, the income stream looked like a coupon on a bond, predictable, monthly, scalable. First movers packaged those rent streams into portfolios, and soon public REITs laid out a roadmap. Acquire thousands, standardize repairs, securitize the cash flows. The stakes landed on everyday streets. Local buyers showed up with FHA pre-approvals and hope. They met cash offers with no contingencies, closing in days. Asking wasn't a conversation anymore, it was a floor. Entry-level inventory, 3 beds, 2 baths, built between the 1970s and early 2000s, vanished from the starter lane and merged onto an investment freeway. Action accelerated. What began as opportunistic scooping evolved into a system. Vendor networks standardized turn costs. The same light fixtures, the same LVP flooring, the same paint codes shaved days off vacancies. Build-to-rent communities sprouted on the edges of fast-growing metros, designed from the ground up not for ownership, but for occupancy. These weren't single anomalies, they were pipelines. There was a subtle shift at the core. Homes stopped being priced as shelters and started being priced as income streams. A cap rate lens replaced the family lens. What's the rent? What's the maintenance? What's the yield? When a home is a spreadsheet cell, its value is what it can earn, not what it means to the people who might live there. That math pulled prices and rents into lockstep, turning neighborhoods into portfolios. Pattern interrupt. The neighbor selling to a neighbor's story didn't slowly fade, it was replaced. Invitation homes, over 80,000 homes, and American homes for rent, nearly 60,000, told investors they'd lean on renewals and scale. One recent earnings call put it plainly. Renewal spreads in the mid-single digits, strong resident tenure, and operational efficiency. Translation: fewer moves for you, steadier yield for them. Meanwhile, something else was happening in boardrooms. Investors realized scattered site didn't have to mean scattered operations. Software stitched together listing data and maintenance tickets. Warehouse credit lines lowered the cost of capital. The capacity to move from 5 houses a month to 500 a quarter became real. Scale compounded. With every 1,000 homes, procurement got cheaper, financing got easier, and leasing got faster. The human cost arrived quietly. A young couple in Phoenix saved for 2 years, then lost 3 homes in a row to cash they never saw. In Atlanta, a teacher with down payment assistance found the same floor plan across town. Only this one was newly renovated and for rent. The monthly number fit. Saving for ownership slipped into maybe next year. Next year didn't get easier. The irony is sharp. The foreclosure era was sold as a painful purge that would reset the market. It did, just not for the families who thought they'd finally buy on the dip. It reset for capital. By the time the dust settled, the mechanisms were in place. Acquisition teams, national vendor contracts, financing partners ready to turn rents into bonds. Starter homes had a new destiny. Here's a microstory that captures the pivot. A Sunday open house in Charlotte draws 5 families. An agent smiles, hands out brochures. By Monday at 10 a.m., the house is gone. The buyer never visited. An API triggered on Saturday. A wire cleared at 9:47, inspection waived, close in 7 days. The families never had a chance to form an offer. One detail would matter later. The purchase price didn't just beat them. It set the comparable for every house on that block. Microstory ad. 2 doors down, a VA-backed buyer offered list with a clean inspection. They lost. A week later, they toured a newly renovated rental around the corner. The same floor plan, gray paint, keypad lock. At a monthly they could afford, but a future they couldn't build. What nobody knew at the time was how sticky those comps would become. Appraisers don't forecast, they verify. One high price, fast-closed deal turns into the proof point for the next. Each comp quietly nudges the ladder up, and as purchase prices firm, rents shadow them. In the aftermath, the neighborhood's baseline shifts, not because the schools changed, but because the spreadsheet did. This was the moment everything changed. A home stopped being a first rung and became a yield. The foundation of today's rent trap was poured in those years. Cheap money, abundant foreclosures, and an emerging toolkit for turning scattered houses into a tradable income product. Buying houses at scale was still slow, though deadlines showing signatures. The breakthrough that removed the friction wasn't more people. It was code. But to see how speed took over, how milliseconds started to decide who gets the keys, we need to follow the bidding machine that came next. Pattern interrupt. While you're waiting on a pre-approval PDF, the bidder you can't see is already under contract, with the same lender's warehouse line. The bidding machine, data, algorithms, and speed. Speed didn't whisper into housing, it crashed the door. A family needs pre-approval, a pay stub, a weekend to tour, another to decide. An API needs a signal. The difference between keys and regrets shrank to milliseconds. While a buyer asks a lender about points, a server pings a listing, checks a buy box, and fires an offer with cash ready on a warehouse line. Human hesitation meets machine certainty. Here's how the machine sees a house. It isn't a porch in a yard. It's a data row. 3 beds, 2 baths, 1,450 square feet, built 1996, roof replaced 2017, school rating 7, HOA compliant, no pool, low capex risk. It ingests MLS feeds, tax rolls, code enforcement logs, flood maps, and utility liens. It screens for floor plans that rent quickly, geofences streets where crime ticks up, and discards anything with oddballs like septic tanks or bespoke additions. The buy box is narrow by design. It's the starter home archetype. What nobody knew at the time, iBuyers taught everyone the speed game. When those models stumbled, they left a breadcrumb trail, failed flips, bulk sell-offs, and clean data. Institutional landlords learned from the carcass. They built connectors into MLS portals, enlisted local brokers as silent scouts, and wired in title firms to pre-clear common issues. The instant offer didn't vanish, it changed owners. Microstory ad. In Dallas, a listing agent hit active on a Friday. By dinner, a national platform offered cash, 7-day close, no inspection. The family who toured Saturday brought cupcakes and a letter. The seller chose the wire. Financing tilted the table. Families borrow at mortgage rates with down payments they had to save. The machine borrows at scale, pulling from warehouse credit lines that price below retail mortgages. Securitized rent deals recycle cash into cheaper debt, lowering the hurdle. When the cost of capital drops a half point, the model can pay 5 or 10,000 more than a human and still hit yield. In a bidding war, inches matter. This is a built-in inch every time. Surprising reversal. Sellers don't have to like institutions. They just have to like certainty. Cash plus no contingencies beats your heartfelt letter 9 times out of 10. Then they fix the slowest part, repairs. Instead of bespoke contractors and guesswork bids, vendor networks turned homes into SKUs. Paint, eggshell, 2 coats. Flooring, LVP, 20 mil per square foot rate. Appliance packages pre-negotiated. Turn times measured in days, not weeks. Crews rotate by zip code. A house that would have sat while a buyer coordinates a handyman gets photo ready in under a week. Speed compounds. Faster turns mean fewer vacant days, which mean the model can stretch a little more on price. Meanwhile, comps reset in real time. Each successful machine bid becomes tomorrow's justification for the next. Appraisers see 3 quick cash closes at a higher level, and the neighborhood floor ratchets up. Sellers anchor higher. Agents advise accordingly. The algorithm isn't just reacting to the market, it's quietly authoring it. Pattern interrupt. You're not just losing one house, you're funding the next price you can't afford. There's a microstory buried in the feeds. Saturday, 3 p.m., an agent in Tampa activates a listing and goes to pick up kids. At 3:02, a bot scrapes it. At 3:05, the valuation engine runs a 20,000 iteration Monte Carlo on rent, vacancy, and turn costs. At 3:07, it flags an anomaly, lower than expected HOA fees. At 3:09, a conditional offer routes to an acquisitions manager's phone with a pre-cleared proof of funds. By 3:15, the seller's agent has a full-price cash offer with a 7-day close. The first open house never happens. Families feel the edge at the moment of decision. Can we sleep on it? Used to be safe. Now by morning, the listing is pending. Even when they jump, their contingencies, inspection, financing, appraisal, look like friction. The machine makes them disappear. No inspection, because vendor reserves handle surprises. No finance contingency, because credit lines. Appraisal gaps papered over by internal marks that justify the spread. The seller isn't choosing the highest sold, they're choosing the least hassle. Meanwhile, something else was happening in the background. Portfolio math trumped street sentiment. A house could be a stretch in one zip, but the blended yield across 10 markets still hit guidance. The machine takes a loss leader to gain a foothold, knowing the comp it sets will lift 5 nearby homes it already owns. That's not a neighborhood decision. That's a balance sheet decision. As scale grew, the model widened. Build-to-rent pipelines piped units straight from builders onto leasing sites, no MLS detour at all. Off-market wholesalers fed pre-approved packages. Title firms created express lanes. Sellers learned to text a number and skip commissions. Every new channel shaved seconds and added certainty. The impact shows up where it hurts most. Price floors lift, and rents follow the friction. When acquisitions remove the discount for inconvenience, neighborhoods lose the slack that once let first-time buyers sneak in. The machine doesn't need to beat every offer. It only needs to win enough to harden the new comp line. There's one more edge. Renewal intelligence loops back into buying. Lease data informs the next zip code. If renewal spreads are 4 to 5% in one cluster, the model bids more aggressively on the next cluster. Financing desks see predictable cash flow and tighten spreads on the next securitization. Cheaper debt enables faster bids. Faster bids generate tighter comps. Tighter comps validate higher rents. The loop closes. Owning the house was half the game. The other half, squeezing the yield, was about to show how a lease could feel like a fee schedule with a front door. The corporate landlord playbook. Owning the house was step 1. Turning it into a high-yield instrument is step 2. On paper, the listed rent looks comparable to the neighborhood. In practice, renters pay more than the sticker, sometimes hundreds more a year, through a maze of add-ons that used to be rare or negotiable and now arrive as defaults. The number on the listing pulls you in. The invoice that follows is where the margin hides. Villain clarity. Public filings and earnings calls spell it out. Renewal spreads remain in the mid-single digits. Fee income a consistent contributor. Occupancy steady above 96%. That's CFO speak for. Don't move and don't expect sympathy. Start with the fee stack. Application fees that don't just cover screening, but administration. A smart home package that flips a $3 lock battery into a $25 monthly charge. Pet rent on top of a non-refundable pet fee. Monthly HVAC filter delivery. Trash valet. Pest control subscriptions. A convenience fee for paying online, even when there's no office to hand a check to. Some fees get disclosed late, sometimes after the deposit is wired. Federal and state scrutiny has started to catch this behavior. Regulators have called out hidden, mandatory charges and deceptive pricing, but enforcement lags operations. Tenants feel it month by month. Pattern interrupt. Your $2, 100 place is really $2,275. Not a budget, an ambush. Stakes are personal. An extra $35 here and $50 there seems small in isolation, but it compounds against wages that haven't kept pace. A family budgeting for $2,100 sees the true monthly at $2,275, and the year-end gap swallows a week of groceries per month. Miss a due date and late policies bite harder than they used to, with automated notices, daily penalty accruals, and threats of filing that start earlier in the cycle. Action inside these companies runs on triage. Maintenance gets split into urgent, necessary, and deferrable. Water leak, urgent. Broken microwave, deferrable. Cosmetic wear, next renewal cycle. Vendor rotations keep costs low, but relationships thin out. You might see 4 different technicians in 3 months, each tasked to close tickets fast, not to learn the house. The net effect: lower operating expenses, higher net operating income, and a resident who learns which repairs get attention and which become background noise. There's a calculus at renewal that most renters never see. The algorithm isn't just setting new lease rates, it's testing elasticity. If the market rent is $2,300 and you're at $2,150, the model might float a 6% increase first, then adjust to 4.5% if you hesitate. Public statements from major players have bragged about renewal rent growth in the mid-single digits even when new lease growth cooled. That tells you where the pricing power sits. With households already settled, schools picked, commutes set. Moving is expensive, the model knows. Evictions: no landlord advertises aggression, but posture matters at scale. When notices auto-generate at 12:01 a.m. on day 4, when payment portals tack on service fees, when partial payments get refused because the software can't reconcile them with policy, leverage shifts. Some of this has landed companies in trouble with regulators for unfair practices. Some of it remains within the gray zone of policy. Either way, the threat is the tool. A family living paycheck to paycheck can't risk a mark that follows them to the next screening. Meanwhile, the lease itself reads differently. Utility pass-throughs appear as allocations without clear formulas. Landscaping obligations shift to residents even in HOA-controlled neighborhoods. Mold disclaimers put burden of proof on tenants. Early termination fees stretch beyond a single month's rent. And dispute resolution funnels to arbitration, where outcomes disappear from public view. The legalese isn't unique to one company. It's a template refined across portfolios. Now zoom out to the P&L. Fee income becomes a line item that investors can forecast. Maintenance savings flow through as margin. Lower delinquency, because policies are strict, improves cash flow predictability. That predictability feeds the financing engine we'll see later, but it also loops back into operations. If a region shows lower turnover and 4 to 5% renewal spreads, acquisitions lean in. The resident's higher monthly outlay becomes the justification to pay more for the next house on the block. Microstory: a nurse in Tampa signs a $2,050 lease after losing 2 bids to cash buyers. The first month, a $75 tech bundle appears: smart lock, thermostat app, Wi-Fi readiness. She already has her own internet and doesn't need the app. Opting out requires a form, a fee, and approval she never gets. When the ASC coils freeze in July, a work order closes with unit functioning, resident education provided. At renewal, the offer is $2,165 plus a new community operations fee. She runs the math and stays, because moving would cost $3,000, and every competing listing shows the same stack. Impact lands quietly, then all at once. Effective rents rise faster than posted rents. Service quality erodes, not catastrophically, but through a steady hum of delays and caveats. Families reorganize budgets, cut back on savings, and accept that the home they maintain isn't the home they control. Neighborhoods absorb higher baselines as leases reset like clockwork. And the emotional shift sets in. Home turns into a line item you can't negotiate with a person, only a policy. What nobody knew at the time was how uniform this would feel across regions. If your experience in Phoenix sounds like your cousins in Charlotte, it's not a coincidence, it's a playbook. The policies are centralized, the pricing is data-driven, and the incentives point in the same direction. If this feels national, that's because it is. Here's the scope. Microstory ad. In Houston, a family called 3 different landlords to ask about fee bundles. 3 scripts, same total. Different logos, identical math. The national picture. Trends that prove it's everywhere. If your lease feels like a math problem, it isn't your zip code. It's the model scaling across the map. The pattern looks local when you're calling maintenance on a Tuesday, but the numbers tell a national story. Families can't just move away from it because the mechanics, how homes are bought, priced, and leased, repeat city after city with only the accents changing. Start with who's buying. In recent quarters, investors have taken a striking share of home purchases, peaking around a quarter to a third of sales in some reports. Most of those buyers are small operators, but the playbook that drives pricing power is set by the bigger platforms. Even if large institutions own only a few % of all single-family rentals nationally, their impact concentrates. In hot metros, their foothold pushes comps, shapes renewal policy, and signals where the floor sits. Meanwhile, investor demand, large and small, competes with families at the very price points where first-time buyers live. 2026 data point. In several Sun Belt metros, institutional buyers captured a double-digit share of single-family purchases again this year, while owner listings stayed scarce due to sub-4% golden handcuff mortgages. Now look at affordability from the renter's side. The rent-to-income ratio has hovered near record modern highs, drifting close to 30% nationally and well above that in expensive metros. Rents jumped far faster than incomes through the last cycle, and even as growth cooled in 2025, the new baseline didn't retreat. In some coastal markets, the income needed to comfortably rent a single-family home borders on six figures, sometimes more. In the middle markets where this used to be easier, Sun Belt suburbs, Midwestern rings, ratios that were once safe now strain monthly budgets. That's the context the renewal algorithms operate in. Where is the model thickest? Atlanta, Phoenix, Tampa, Charlotte. Fast growth metros with job inflows, easy highway access, and 1990s, 2000s subdivisions built to a template. In Atlanta's outer counties, a starter ranch becomes an investment-grade unit with a lockbox and a waiting list. In Phoenix's West Valley, renewal spreads in the mid-single digits hold even when new lease demand softens, because schools and commutes pin people down. Tampa's HOA-heavy neighborhoods make maintenance predictable, which investors prefer. Charlotte's build-to-rent corridors deliver whole blocks to leasing desks in one shot. The local flavor changes, but the output is similar: tighter comps, higher effective rents, lower churn. Vacancy dynamics are the quiet engine. Turnover fell as moving got expensive. That gives landlords the power to lean on renewals, not chase new leases. A 4 to 5% renewal increase sounds modest until you stack it on fees and another cycle of inflation. Keep occupancy north of 95%, and the revenue math pleases lenders and ratings desks. That predictability feeds back into acquisition appetite, which reinforces the floor under prices. Meanwhile, lower turnover means fewer chances for families to catch the rare discounted listing. The carousel slows, and the tickets get pricier. Think about comps as a nationwide ratchet. A cash close at a premium in one tract turns into appraisal support for 3 nearby tracts. Appraisals don't ask why, they note what cleared. In neighborhoods where investors cluster, this creates a pricing spine. Sellers learn to aim high and wait for the frictionless buyer. Agents, seeing fast closes with clean terms, coach accordingly. Even when new lease growth cools, renewal growth holds that elevated rent line in place. The net effect: a rising floor that outlasts the headline cycle. There's a parallel with supply. New apartments surged in 2024 to 2025, easing pressure in dense cores. But single-family rentals occupy a different niche: yards, garages, school districts. Build-to-rent bridge the gap, delivering suburban houses straight to rental portfolios. That adds units, but it doesn't restore the starter-for-sale stock. Families hunting for a first purchase find fewer choices and more rent-ready homes. The latter's first rung becomes a monthly bill. 2026 data point. Despite a wave of apartment deliveries, single-family rental vacancy held tight in key metros, keeping renewal leverage high. Policy hasn't caught up to the speed. Some states pushed fee transparency. A few enforcement actions called out hidden charges and deceptive pricing. But rules move slowly. Operations adapt quickly. Even where fee rules bite, pricing power shifts to base rent and renewal posture. In the aggregate, the model still extracts predictability from households and translation into financing terms. Here's the human beat inside the stats. In Charlotte, a couple budgets to move when their baby arrives. Their renewal jumps by a couple hundred plus a new line for community operations. Competing listings pack the same fees. The move would cost several thousand in deposits, movers, and missed work. They stay. Across Tampa, a nurse calculates that buying would be cheaper monthly, but the down payment gap widened after 2 years of chasing outbid offers. She stays. In Phoenix, a teacher lands a place after a 3-day scramble and signs to avoid competing again. She stays. Renewal power isn't a slogan, it's inertia turned into revenue. Nationally, this adds up to a rent floor that's hard to duck under. Even as growth cycles ebb and flow, the baseline drifts higher and lingers. The starter home ladder, once built from ordinary wages and time, now sits behind cash offers, policy delays, and fee architectures. You're not seeing a few bad actors, you're seeing a system optimized for yield. And behind the logos are names, companies with earnings calls, investors with mandates. Let's call them by name. The players: Invitation Homes, American Homes for Rent and Company. Names make systems real. Invitation Homes sits at the top. Tens of thousands of houses across Sun Belt grids, occupancy north of 96%, and a platform they like to call resilient. Their message to investors lately has been simple: renewal rent growth in the mid-single digits even when new leases cool, high resident tenure, and pricing tools that keep revenue steady. We continue to see 4 to 5% renewal growth with strong retention, is the kind of line that shows up on calls. Translation for renters: moving hurts you more than them, so they lean on renewals. American Homes for Rent runs a similar play, with a twist they build. Nearly 60,000 homes, and a growing share coming from their own development arm, delivering communities purpose-built for long-term rental cash flow. Scale is their advantage and their story. With thousands of homes, procurement discounts shave dollars off every lock set and refrigerator. National maintenance networks keep turn times predictable. Leasing funnels sort applicants at speed. Investor decks frame this as service and efficiency. Residents experience it as uniform policy, fewer exceptions, and a rent number that rarely blinks. Public filings and proxies add a line they like to repeat: renting their homes is more affordable than owning in many of their markets. That might be true on a monthly cash basis at today's mortgage rates, but it also tells you the model works best when buying is out of reach. How do they keep growing? Acquisition channels multiply. Bulk portfolios from smaller landlords, one-off scattered site buys that fit the buy box, and build-to-rent partnerships with national builders who offload entire streets on certificate of occupancy. Off-market pipelines hum. Wholesalers text deal sheets, local brokers collect finder's fees, and title firms pre-clear common defects. The MLS is just one river. Private streams feed the machine. The pressure comes from the top of the capital stack. Public markets want steady growth in funds from operations, expanding margins, and clear guidance. On earnings calls, executives talk about pricing power and renewal spreads. One typical disclosure: renewals at 4 to 5%, new leases modest in supply-heavy submarkets. When a CEO highlights renewal growth while admitting new leases are flat to down in a few markets, that's the strategy in plain language. Protect in-place revenue, accept softness at the edges, and let churn shrink. It's not personal, it's guidance. Then there's the money you never see, the silent fuel. Pension funds and university endowments sit behind a lot of private SFR platforms, and some public, ones via equity stakes and debt. Teachers and firefighters' pensions, Ivy endowments, capital with mandates for stable, inflation-linked yield. When CIOs write allocation memos, they like rent checks that act like bonds. Commitment schedules demand deployment, which means acquisition teams need product. Optics get messy when beneficiaries are renters facing hikes, but the machine answers to target returns. Business model snapshots draw the same shapes. Average rents in the low to mid $2,000s in many metros, NOI margins lifted by fee income and tight expense controls, and occupancy managed like a thermostat, high enough to reassure lenders, with renewal increases set by elasticity tests rather than neighborhood feel. Fee lines, smart home, pet rent, trash valet, admin, aren't afterthoughts, they're modeled contributors to growth. Lower delinquencies because policy. Lower capex surprises because standardized specs. Predictability is the product. Here's a microstory pulled from the investor side. Mid-quarter, an analyst asks about renewal strategy in softening Sun Belt markets. The CFO answers, "We're targeting 4 to 5% on renewals, testing price sensitivity and adjusting where needed. New lease growth is modest due to supply in select submarkets." It sounds dry until you map it to a kitchen table. That's the letter you get with a bump you didn't budget for, justified by market conditions the company defined with its own comps. Not every big player is a household name. Progress Residential, Tricon Residential, NextPoint, private platforms with tens of thousands of homes and similar mechanics. Some manage for third parties, extending the model's reach beyond owned doors. Some originate loans to builders, tying supply to their leasing funnels. The logos differ, the spreadsheet reads the same. Impact comes back to your lease. Wall Street incentives meet neighborhood realities in the lines you initial. A corporate landlord's promise to investors, steady growth, disciplined expense, low turnover, shows up as renewal asks, firm fee policies, and repair triage that favors budget over speed. None of this is secret. It's reported, ranked, and rewarded. Which raises the next question. How do these operations turn your monthly check into a tradable security? And why does that? Push them to enforce, not flex? Securitizing your rent check. Here's where your lease meets Wall Street. That monthly transfer doesn't just vanish into a landlord's account. It feeds a machine that slices, rates, and sells streams of rent like bonds. The product has a clean nickname on banker decks: single-family rental securitizations. Inside, thousands of leases flow into a trust. Out the other side come tranches. Senior pieces with steady coupons, riskier slices with higher yield, all backed by your on-time payment. Pattern interrupt. To the bond buyer, your late fee isn't a nuisance, it's risk control. The stakes are simple and sharp. If your rent is a bond payment, your late fee becomes a covenant. The trust expects cash on a schedule. Servicers, often the landlord's affiliate, promise investors they'll keep delinquency in a tight band, vacancy low, and expenses predictable. Miss those targets, and spreads widen on the next deal. Hit them, and financing gets cheaper, which keeps the acquisition engine humming. Walk through the plumbing. A landlord pools a few thousand homes into collateral. Cash flows, rents net of fees, maintenance, taxes, insurance, get modeled under stress scenarios. What if vacancies tick up? What if deterioration costs rise? What if renewal growth slows? Ratings firms review the data, check historical performance, and assign grades. The top tranche, the AAA-like slice, gets paid first and priced tight. Below it, mezzanine tranches take more risk and earn more. At the bottom sit residual pieces that soak losses, but enjoy upside if performance beats the model. Then comes the feedback loop. Cheaper securitization financing lowers the landlord's cost of capital. Lower capital costs mean they can outbid families by a few thousand and still meet target yields. Those wins set higher comps, which justify higher rents, which fatten cash flows that feed the next securitization at even better terms. The loop doesn't need fireworks, it just needs repetition. Each deal refines the model, and the model governs your renewal letter. What nobody outside the room sees is how granular the covenants get. Pool documents spell out delinquency triggers, loss reserves, even maintenance spend expectations. If delinquencies push past a threshold, excess cash sweeps into reserve accounts instead of upstreaming to the parent. That punishes the platform. So policies tighten. Late fees are rigid, payment portals restrict partials, grace periods shorten. It's not cruelty, it's compliance. Risk gets shifted with a spreadsheet. Vacancy and downturn risk don't vanish. They're spread across tranches and investors hungry for yield. Pension funds, insurance companies, and asset managers buy the senior slices for stability. Hedge funds and credit shops take the riskier pieces for return. The landlord keeps skin in the game through equity or subordinate bonds, which aligns incentives, up to a point. When push comes to shove, the servicer answers to the indenture, not the tenant. There's a human thread in that legalese. A dad in Phoenix begs for a week because his paycheck clears on Friday. The portal refuses partial payment. Policy says full amount only. An automated notice posts a 3-day demand, fees stack, and the account flips into collections risk. Somewhere in a trust document, that rigidity exists to protect a coverage ratio by month end. The family doesn't see the ratio. They see a lock changing if they miss the window. Microstory. A leasing agent in Tampa explains a new late fee schedule, $100 flat plus $10 per day. She shrugs and says, "It's the policy now." A colleague mutters that the bond deal closed last quarter, and they're watching roll rates. Roll rates are the percentage of tenants who go from current to 30 days late. Keep them low, and the platform celebrates credit discipline. Let them drift, and the next securitization pays more to borrow, which means pressure to raise rents or fees later. Meanwhile, performance data from the bond world loops back into acquisitions. If a cluster of homes in Charlotte shows low delinquency and strong renewal spreads, that submarket earns a higher bid ceiling. If repairs in a Phoenix tranche came in under budget thanks to standard specs, CAPEX assumptions tighten across the platform. Each tweak in the underwriting lets the company pay a little more or stretch a little farther on terms. Wall Street's comfort becomes your competition's new normal. Legal wrappers make this scalable. Master trusts let issuers add new pools over time, keeping paperwork lean and pricing consistent. Warehouse lines bridge the gap between acquisition and securitization, so cash is always ready. Law firms and ratings shops form a cottage industry around this pipeline, turning homes into fixed-income product as routine as car loans, just bigger and slower to move. There's a narrative companies prefer. Securitization brings stability, lowers costs, and expands access to good rental housing. There's truth in the first two. Lower financing costs do keep operations funded and, in theory, temper rent volatility. But stability for investors often means inflexibility for renters. A policy that forgives a fee or waives a hike may please a family. It muddies a cash flow promise. The bond doesn't care about your kid's school start date. It cares about principal and interest on the 15th. In the aftermath, neighborhoods become pipelines. Leases turn into predictable streams. Repairs are budget lines. Evictions are performance metrics. And in quarterly decks, executives point to strong securitization execution as proof the model works. They're right from their chair. From the kitchen table, it feels like the rules got written elsewhere. This machinery needed fuel, cheap capital, trapped renters, and thin for-sale inventory. The economy handed it over. Now the question is why the pace quickened this year, and what that means for anyone who's still hoping to buy. Why now? The tipping point, January 2026. The timing isn't abstract, it's biting right now. Waiting 6 months in 2026 isn't neutral, it's costly. Renewal letters landing this winter carry mid-single-digit bumps even where new leases are flat, and every extra month of "we'll see" means another fee cycle, another comp set, another financing round that tightens the screws. The urgency isn't fear-mongering, it's arithmetic. Delay sits on the wrong side of the spreadsheet this year. 2026 data points. In many Sun Belt tracts, renewal asks are clustered around 4 to 5% with occupancy still above 96%. SFR bond spreads priced tighter on strong 2025 performance, lowering acquisition hurdles. Builders are delivering more build-to-rent phases straight to portfolios, bypassing the MLS entirely. Catalysts stacked in a way that favors scale. Mortgage rates stayed high enough to trap would-be sellers in their 3% loans, freezing for sale inventory. That keeps renters put and reduces move-out risk, the exact tenant profile corporate models prize. Builders, seeing clogged resale channels, deepen their build-to-rent pipelines. Entire phases now skip MLS and flow straight into portfolios with rent-ready finishes, predictable HOA regimes, and maintenance templates. When supply shows up, it shows up as product for leases, not keys. Pattern interrupt. More houses got built, just not for you to buy. Meanwhile, the guidance coming from the big landlords signals confidence. Executives talk about 4 to 5% renewal rent growth with high resident tenure and pricing power that holds even as new lease demand softens in pockets with fresh apartment supply. Translation: they'll protect in-place revenue first. For households, that means the raise you didn't get becomes a rent increase you can't dodge without paying to move into the same policy elsewhere. There's a macro shove behind it all, the yield panic that never really ended. Inflation dented real returns on cash and bonds for years, and even as headline CPI cooled, allocators stayed hungry for inflation-resilient cash flows. Rent checks fit the brief. A 4 to 6% unlevered yield, paired with the ability to nudge renewals and stack modest fees, compares favorably to low bond coupons. CIO memos from 2024 and 2025 greenlit single-family rental funds and build-to-rent partnerships, and those commitments are being deployed in 2026. Capital raised has a clock. It doesn't sit politely while families save. Financing terms reward consistency. Securitization desks saw steady performance through 2025 as delinquency stayed contained and renewals carried revenue. That let issuers price tighter on senior bonds and keep warehouse lines humming. Cheaper debt lowers acquisition hurdles, which allows a few $1,000s of extra bid room on every buy-box home without breaking returns. Those marginal wins keep lifting comp lines in targeted tracks, which feed back into appraisals and renewal confidence. It's a machine tuned for a year like this. Policy hasn't caught the cadence. Yes, regulators have started leaning on deceptive junk fees, and 1 or 2 high-profile settlements made headlines. A handful of states pushed fee transparency and timelines for repairs. But enforcement is slow, appeals are slower, and national rules remain patchy. Platforms already adjusted disclosures and shifted economics into base rent or renamed fee lines. The algorithm moves faster than the docket. The net effect: households see cleaner line items, not cheaper outcomes. On the ground, low resale inventory keeps families pinned. Owners with golden mortgages aren't listing. Buyers face shallow shelves and fast-moving cash offers. That concentrates competition in the starter tier, where institutions already have a playbook. A would-be buyer priced out in 2024 and 2025 enters 2026 with more savings, only to meet a tighter comp line, a fresh round of build-to-rent units, and a landlord happy to renew them at a modest increase. The target moves as they approach it. Builders have recalibrated too. Build-to-rent gives them certainty, bulk closings, minimal fall-through, and fewer punch list battles. In exchange, portfolios get streets designed for operations. Durable materials, uniform layouts, low capex exteriors. That's great for maintenance budgets and bond models. It's a door closing for entry-level buyers who used to catch builder spec cancellations or end-of-quarter discounts. The pipeline that once bled into the MLS now empties into leasing sites. 2026 data point. Multiple national builders flagged higher BTR take rates on earnings calls this year, citing programmatic partnerships with institutional buyers. There's a quiet demographic push as well. Pandemic-era migration reshaped Sun Belt metros, and those households aren't leaving. Job growth persisted in logistics, healthcare, and tech-adjacent services across second-ring suburbs. Those wages support rent, if not down payments, and support renewal discipline. A landlord doesn't need sizzle in new leases when churn is low and the resident base is sticky. The model is designed to harvest that stability. Investors read the same signals and move in a herd. Reports highlight stable occupancy over 96%, modest national rent growth, and pockets of softness where new apartments delivered. But the single-family niche, yards, garages, school districts, stayed tight. That divergence tells capital to lean into SFR over downtown Class A. Money concentrates where households can't easily substitute. Again, it's not a conspiracy, it's a spreadsheet chasing a constraint. So why now? Because the gears that matter, capital costs, supply channels, policy friction, and tenant stickiness, lined up. 2026 isn't just another line on a chart. It's the year the machine gets everything it needs at once. If you're renting, that shows up as a renewal you can't ignore and a fee structure that survives cosmetic reform. If you're trying to buy, it's fewer true starter homes and more lookalikes built for leases. For buyers, the dream didn't just drift away. It was outbid, routed, and refinanced before you woke up. The next chapter isn't about sentiment. It's about competing in a rigged-feeling market without making a fatal mistake. The vanishing starter home. Losing the first rung doesn't just delay a move. It rewrites a life's math. Home equity is forced savings, leverage on raises, and a cushion when life throws a curve. Take it away for 5, 7, 10 years, and the compounding that would have worked quietly in the background simply never starts. You don't feel the missing dollars day one. You feel the absence of tomorrow's options. Here's how the ladder pulled up. Bulk cash offers lifted price floors, then appraisals locked them in. The PMI-thin buyer, the one stretching to 3% down with a clean file, needed luck and timing. Instead, they met a market where as-is, 7-day close looked normal and contingencies looked like obstacles. Each fast cash close didn't just beat a family. It raised the bar for every family after them. In practice, that bar is a dollar gap. Talk to loan officers in Phoenix and Charlotte, and you'll hear the same refrain. The spread a corporate buyer will tolerate versus a financed buyer's ceiling runs about $10,000 to $20,000 on a typical starter. That doesn't sound massive until you map it to a savings plan. At $700 a month saved, that's a year to 2 years of extra waiting. While rents climb and life gets more expensive. Stack the math. Suppose a couple aimed at a $350,000 home 2 years ago, needed $25,000 to close comfortably, and had $18,000 saved. They planned to bridge the gap over 12 months. Instead, comps ratcheted to $370,000, and rent rose $175 a month. Their savings pace slowed, their target jumped, and the last mile stretched by another year. Meanwhile, the corporate bid that set the comp was justified by an internal yield model tied to rent data from nearby leases. The loop reinforced itself while the couple treaded water. There's a time penalty hidden in maintenance and repairs, too. A for-sale starter usually needs sweat equity, paint, fixtures, small fixes you trade for a lower price. Corporate buyers erase that discount by standardizing turns and marketing newly renovated rentals. The house that would have sold at a modest haircut becomes a premium rental. The discount for elbow grease, an entry point for first-timers, shrinks. Then there's the mortgage rate trap. Owners with 3% loans didn't list, so the resale pipeline ran dry right where first-time buyers shop. Builders filled part of the gap, but a growing share flowed to build-to-rent. Those homes look exactly like the starter inventory families want. Single-story, 1,600 square feet, a small yard, a two-car garage, but they bypass the MLS and land behind a leasing link. The optical illusion is brutal. The neighborhood is full of starter homes, and none are for sale. Meanwhile, years matter. If you buy at 30 and ride 2 market cycles even, conservative appreciation and principal paydown build 6 figures by 45. Buy at 38 and you ride 1. The difference shows up in college choices, business starts, and retirement dates. It also shows up in resilience. Owners can refinance to manage shocks, tap a line for emergencies, or sell and reset. Renters face renewal letters and moving costs. Intergenerational wealth gaps widen with every missed cycle. Parents with equity can help children bridge down payments. Parents without equity can't. That's not morality, it's math. When corporate bids raise floors and rents rise in parallel, families who almost make it watch the goalpost slide just out of reach. A year becomes 3, then 5, and the compounding they intended to claim is busy working for someone else's balance sheet. There's a human beat in Charlotte. A warehouse supervisor and a nursing assistant stacked overtime for a year. They wrote 5 offers, lost 5 times, then found the same floor plan down the road. Fresh LVP, gray paint, black pulls, pets welcome. $2,195 a month plus fees. It was clean, immediate, and certain. They signed, promising themselves it was temporary. 2 renewals later, their savings account is intact, but smaller than it would have been without unpredictable add-ons and a car repair that would have been a hellic draw if they'd owned. Atlanta tells a variation. A teacher and a city bus driver targeted a 197's ranch. The appraisal came in light, and the seller wouldn't budge. A previous cash comp set the expectation. They could bridge the appraisal gap, but doing so would drain their reserves and trigger PMI at a higher rate. Their counselor advised walking. Months later, they saw the same house with a keypad on the door and a professional photo set. The rent penciled cheaper than the new mortgage quote. Today, the long-term cost hid in plain sight. Meanwhile, kids grow. Commutes cement. School calendars dictate timing. Each life constraint makes wait for the right listing harder, and the policy-driven machine thrives on that. Renewal increases lean on inertia, and the acquisition side counts on the fact that the longer families rent, the less likely they are to jump at the next ragged listing with a leaky roof and odd wiring. Comfort beats aspiration when the price of aspiration keeps inching up. The punchline isn't that no one can buy. People still win with sharp teams, pre-underwriting, and creativity. But the default path, save a bit, find a tired house, fix it slowly, has been paved over by cash, code, and capital. The starter home didn't vanish from the map. It vanished from the market you can actually enter. And while you wait, the meter runs. The next chapter gets practical. How you defend your wallet now, and where to press for real savings this year. Tactical defense, renter's playbook against institutional landlords. Defense isn't glamorous, but it saves real money this year. The playbook starts before you tour, because the best leverage is knowing who owns the door and how their system works. Every $25 add-on compounds. Your job is to turn a policy machine into a negotiation, step by step. First, identify ownership. Listings won't always show the brand, but tax records will. Search the county assessor for the property address and note the owner LLC. Cross-reference the LLC with the state's business registry. Look for patterns like multiple properties, out-of-state mailing addresses, and registered agents used by big platforms. If the name ties to a REIT or a known operator, assume standardized policies, good for predictability, and usable as leverage when they deviate. Second, read the red flags in the listing itself. Phrases like smart home enabled, resident benefits package, and mandatory utility enrollment are fee tells. Ask for the full fee schedule in writing before you apply. If they resist, that's a signal. Application fees should be one-time and cost-based. Duplicate administration or processing charges are where junk fees hide. If your state or city has a fee transparency law, cite it and request line item totals. Base rent, monthly fees, one-time fees, utilities, and deposits. Now the lease audit. You're looking for unenforceable or illegal fees, and for terms you can soften. Skin 4, mandatory convenience fees to pay online, recurring filter or pest charges without opt-outs, vague allocation formulas for utilities, early termination penalties above 1 to 2 months, and arbitration clauses that block small claims court. Many states cap late fees or require disclosure of every mandatory charge. If a line item appears post-signature, contest it immediately and in writing. Email plus certified letter, so you create a record. Utilities deserve a closer look. Ratio utility billing systems, RUBS, often overcharge. Ask for the formula and prior 12 months utility histories for similar units. Where submetering isn't installed, negotiate a flat cap or insist on provider bills in your name. If the lease requires enrollment in a landlord's utility program, push for opt-out with proof of your own account. Next, tactically negotiate. Institutional platforms have less flexibility on base rent, but more on structure. Offer a longer lease, 15 to 24 months, in exchange for a smaller initial increase and a cap on the second-year bump. Push for a written renewal cap stated in dollars, not market. Trade certainty they value, longer tenure. For certainty you need predictable payments. If they won't cap in writing, request an addendum for a preset renewal offer window with a right to decline without penalty. Use timing. Apply during off-peak cycles in your market, often late fall to midwinter, when leasing velocity slows. Ask your local agent about average days on market and concessions. If new apartments nearby are offering free months, bring printed offers. Institutional landlords track comps. Showing substitutes unlocks concessions like application fee credits, admin fee waivers, or a month's resident package waived. Don't ask for a lower base rent. Ask for recurring fee reductions and move-in credits that hit your first-year effective cost. Maintenance is leverage, not just comfort. Before signing, submit a written punch list from your walkthrough. Loose handrails, dripping valves, missing screens, and require completion in 5 business days post-move. Tie completion to a rent credit if missed. Platforms respond to SLAs. During the lease, log every issue in the portal and screenshot confirmation numbers. If service lags beyond statutory repair timelines, send a formal notice citing your state's habitability rules. Escalate to the corporate resident relations or compliance address listed in their filings. Platforms track those inboxes. Escalation channels matter. Many institutions publish an ethics hotline or compliance email in investor materials. Use them when property-level staff stonewall. File complaints with your state attorney general's Consumer Protection Division and your city's housing department when hidden fees appear or repairs stall. Attach your paper trail. Balanced, factual complaints get faster traction. If federal or state agencies are scrutinizing junk fees, reference the applicable guidance when you contest add-ons that weren't disclosed. Consider bargaining chips beyond cash. Offer to handle mowing or basic filter changes in exchange for removing the resident benefits package. Request landlord-funded improvements with multi-year leases, ceiling fans, closet shelving, or a garage door keypad. Get every promise in a signed addendum with completion dates. Verbal will take care of it, vanishes at renewal. Plan your exit options early. If you might move, negotiate a reasonable break fee clause up front, 1 month plus. Notice, rather than a sliding scale. If they refuse, set a calendar reminder 90 days before lease end to trigger notice and shop alternatives. Time your move to shoulder seasons when movers and landlords are cheaper. If you stay, start the renewal process 75 days out. Ask for the renewal in writing, then counter with data, comps, concessions, and your clean payment history. Use competition quietly. Create a simple spreadsheet of 3 comparable homes with full-in pricing, base rent plus all recurring fees. Email it with your counter, highlighting total monthly differences. Avoid emotion, present numbers. If they hold firm, pause. Some platforms auto-improve offers after a week if occupancy targets aren't met. Finally, organize knowledge. Join local tenant groups or online forums specific to your landlord brand. You'll learn the quirks, which fees are commonly waived, which markets flex, which email addresses respond. Share your wins and templates, fee disclosure requests, addenda, and escalation letters. The playbook works best when many use it. Defense won't rewrite the system. It will cut surprises, cap hikes, and keep hundreds, sometimes thousands, in your account this year. That buys time, and time is your most valuable asset while the machine runs. Buying in a rigged market. Smart offense. Offense starts before the listing hits your phone. Pre-underwrite your life the way an institution underwrites a deal. Build a full file with a local lender who actually answers on weekends. 2 years of W-2S, pay stubs, bank statements, gift letters prepped, credit disputes resolved now, not mid-escrow. Ask for a fully underwritten approval, not just a pre-qual. That lets your agent write loan approved, credit and income verified, shrinking the seller's fear that you're a maybe-san-if buyer. Rate buydowns are tools, not trophies. Work scenarios with your lender. Permanent buydown versus a larger seller credit to cover closing costs, especially if you don't plan to hold the loan beyond 5 to 7 years. Don't chase the lowest rate sticker if a bigger credit keeps cash in your pocket for appraisal gaps or repairs. Ask for the break-even month. If it's past your likely move or refi window, take the credit. Search where the machine isn't watching. Write to owners of long DOM properties with small cosmetic issues. Older roof but no leaks, dated kitchens without weird structural quirks. Your letter isn't flowery, it's specific. Financing approved, timeline flexible, inspection focused on health and safety, quick appraisal. Hit builder spec cancellations, homes a buyer walked from because rates jumped or a job changed. Builders hate backlog. End of quarter pressure produces price adjustments or credits that don't show on public feeds. Expand the ring. 10 to 30 minutes beyond the hot zip. Look for small towns with solid schools and older subdivisions the buy box shuns. Septic, larger lots, non-HOA pockets, or homes with unusual but functional features. Corporate models prefer uniformity. Your advantage is comfort with imperfect but fixable. A solid well and septic test can be your financing fuel where others won't play. Design offers that remove fear without lighting your wallet on fire. Cap your appraisal gap. Buyer to cover up to $8,000 shortfall, so you're competitive without writing a blank check. Trade price for credits where it helps you more. $10,000 credit beats $10,000 price cut if you need cash for repairs and costs. Use inspection strategically. Waive cosmetic asks, but keep rights for major systems and safety. Offer a free rent back for 2 to 4 weeks if the seller needs time. That one line can beat another buyer's extra $2,000 because it solves a human problem. Timing matters. Focus on listings that stale past 14 days. Algorithms cool, and human sellers start listening. Write Friday morning for weekend showings. Be first in the stack. If you lose on price, be second position with a clean backup offer that auto-activates if the first buyer stumbles on appraisal or financing. Backups win more than people think. Build a team that plays your market, not a script. A hyperlocal agent who knows which HOAs are lawsuit-free, which inspectors actually crawl attics in August, which appraisers understand non-standard comps. Add a sharp attorney or transaction coordinator to keep addenda precise, especially appraisal gap caps, repair escrows, and rentbacks. Lenders matter more than logos. You want the person who calls an underwriter at 6 p.m., not a call center that emails Monday. Know when move-in ready is a trap. The LVPN Gray special invites you to overpay for someone else's flip margin. Instead, hunt value add you can execute without permits. Paint, floors, fixtures, landscaping, minor bath refreshes. Price the scope with 2 contractors before offering. Carry a contingency for surprises. If the home needs major systems, insist on seller credits or a price that reflects it. Don't fund a new roof. Twice, once in price and again with your cash. Bring data, not vibes, to negotiation. Hand the seller's agent a one-page sheet. Your approval, local lender contact, earnest money size, targeted close, appraisal gap cap, inspection scope, rent back terms, and a brief summary of comps with a sober valuation. Include a short note about your flexibility on closing date and your clean contingencies. Don't send a novel, send certainty. Use micro-auctions smartly. If a property attracts offers, ask the listing agent what matters most to the seller: net, timing, rent back. Then aim your advantage at that lever. If they care about net, raise price but ask for a lender credit via rate choice to preserve cash. If they care about timing, shorten escrow with your underwritten file. If they hate repairs, set a dollar threshold for requests and agree to handle cosmetic items yourself. Avoid fatal overpays by setting a walkaway number before you tour. Tie it to monthly payment at your worst-case rate plus the maximum cap you'll cover on appraisal. If the bidding crosses that line, stop. You're not trying to win every house. You're trying to win a house that pencils through your first roof leak and a surprise daycare bill. Finally, stage your liquidity. Keep reserves liquid and visible to underwriters. Don't move money mid-escrow. If you'll use a gift, paper it early. If your down payment is tight, ask your lender about community seconds, DPA programs with quiet seconds, or lender-paid mortgage insurance that improves monthly at the cost of slightly higher rate. Sometimes the trade wins you the appraisal gap room. You won't beat the machine everywhere. You don't need to. You need a handful of edges that, stacked together, make a seller choose your certainty over their convenience. That's how you win selectively, at prices you can live with after the keys change hands. Alternative paths, building wealth outside the trap. Not everyone will buy soon, and that doesn't mean you stand still. The goal is to keep compounding while the housing machine does its thing. You shift from waiting to working. Build cash flow you control, hedge what you can't, and stack small edges that matter over years. Start with mobility math. If you can work remote or semi-remote, widen your map to places where corporate ownership is thinner and pricing less algorithmic. Search metros where investor share is lower and in-place rents haven't sprinted past incomes. A move from a Sunbelt hot zone to a nearby second-ring city can cut rent or purchase price by hundreds a month. Those savings aren't theoretical, they become your down payment engine. Run a simple spreadsheet. Current rent minus target rent, add tax differences, subtract travel or childcare changes, and annualize the gap. If the move saves $800 a month, that's $9,600 a year, real fuel. If moving states isn't in the cards, look for micro-arbitrage across neighborhoods. Non-HOA pockets, older stock with individual owners, duplex basements with lower fee stacks. Even a $150 monthly reduction, combined with fee eliminations you negotiated, becomes a contribution to an earmarked equity fund. Now build the portfolio that buys you time. Use tips as your inflation seatbelt. Ladder maturities, 6, 12, 24 months, to match near-term goals and protect purchasing power while rates are decent. Pair that with a core of low-cost index funds, broad US, a slice of international, plus dividend growth if you want steadier cash flow. The dividend yield won't replace rent hikes, but reinvested, it compounds while you wait. Be selective with REITs. It's fine to own real estate on paper, but don't blindly buy the same model you're fighting at the kitchen table. If you add REIT exposure, diversify across sectors, industrial, data centers, healthcare, and size it so you're not betting your rent on your landlord's margins. Read fee disclosures and payout ratios. Avoid vehicles that juice yield by selling assets. Automate savings like rent is due to your future. Direct deposit into a high-yield cash account or short-term treasuries via automatic purchases. Treat it like a bill, first, not last. If your employer matches a 401k, max the match even if home is your main goal. Free money compounds. For taxable accounts, keep it simple. 1 or 2 ETFs, monthly buys, no hero trades. Create side capital that mirrors house hacking without a mortgage. If your lease allows, rent a room to a traveling nurse or graduate student on midterm stays with clear agreements. The income can offset fees you couldn't kill. If local rules allow ADUs and your landlord will write it, propose a landlord-funded or shared-funded shed-to-office conversion with a rent discount or revenue share for furnished rentals. Document it and protect yourself with a clear addendum. Where that's impossible, build human capital instead. Certifications that raise income inside 6 to 12 months. A $300 monthly raise beats chasing $25 fee waivers forever. If you do stay planted, professionalize your cash cushion. 3 to 6 months of expenses in a ladder of T-bills or high-yield savings avoids tapping credit cards when policy rigidity bites. Consider I-bonds if the window opens and you can lock funds for a year. They're boring and useful. Debt triage matters. If you carry balances, roll them into the lowest fixed rate you can get, then snowball payments. Every dollar of interest you kill is a risk premium you stop paying to someone else's balance sheet. If your credit score is close to a key threshold, prioritize the moves that tip you over. Utilization below 30%, a paid-off small installment loan, disputes settled months before an underwriter looks. Keep optionality alive with small experiments. Partner with friends or family on a tiny equity investment where you control terms. An owner-financed lot, a small storage unit in a town you can manage, or shared equity in a live-in duplex your cousin will occupy. Write proper agreements, plan exit routes, and size them so failure doesn't sink you. The point isn't to stretch, it's to learn, earn, and keep your buying muscles active. Document your next home fund as a separate identity, a nickname, a target number, and a date. Post progress where you see it weekly. Momentum is psychology as much as math. When the right house appears, you want cash ready, credit tidy, and a brain used to quick, clean decisions. Finally, remember the wealth lens is wider than housing. Skills raise income. Health avoids expensive surprises. Community creates job leads and safety nets. Every hour you put into those buys you negotiating power later. Over a lease, over a mortgage, over your time. Rules can change, incentives resist. So you build in the space you control, buy time on good terms, and keep your shot lined up for the day the door opens. Policy front. Pressure points that actually matter. Policy can blunt the sharp edges, but blunt isn't enough. You need levers that shift incentives without choking supply. The goal isn't a slogan. It's surgical pressure that changes how the spreadsheet behaves. Broad caps and blanket bans often backfire. Narrow, enforceable rules can move dollars back to households fast. Start with fee transparency and junk fee bans that have teeth. Make all mandatory charges disclosed in the listing and the first page of the lease, in a single total next to base rent, with prohibited categories spelled out. Duplicate admin, mandatory convenience fees to pay online, undisclosed benefits bundles. Tie violations to automatic tenant refunds plus statutory penalties, and give state attorneys general clear authority to enforce. Set a private right of action in small claims court for amounts under a threshold so tenants don't need lawyers to claw back $300. Publish a standard disclosure form landlords must attach to applications, base rent, recurring fees, one-time fees, utility method, so shopping becomes apples to apples. Next, time matters. Enforceable repair timelines change behavior. Define habitability tiers, emergency, urgent, routine, with clock starts and consequences. For emergencies, 24 hours to mitigate. For urgent, 72 hours to address. For routine, 14 days to complete. If timelines lapse, rent automatically abates by a set daily amount until correction, and tenants can hire licensed vendors to fix with costs offset against rent. Require transparent work order histories accessible to residents and regulators. When performance shows up in a public dashboard, portfolio operators feel it. Late fees are another pressure point. Cap them at a reasonable flat amount or small percentage. Bar per day accruals beyond a short window, and mandate grace periods tied to pay cycles, say, the 5th of the month. Allow partial payments and require portals to accept them, prohibiting full balance only locks that weaponize software. Pair this with structured hardship mediation before eviction filing, a short, standardized plan, 2 to 3 months, to cure arrears without junk add-ons, with filing paused while plans are active. Courts move slowly, software moves fast. Mediation slows the machine where it bites. Utility transparency deserves its own rule. If a property uses RUBS, require disclosure of the formula, historical averages, and a monthly cap unless units are submetered. Encourage submetering with tax incentives, ban padded processing, add-ons for utility pass-throughs. If the landlord runs an in-house utility program, prohibit enrollment fees and require opt-out if tenants can secure service directly. Bills should read like bills, not revenue opportunities. On acquisitions, sunlight beats speculation. Require public disclosure when a buyer crosses bulk thresholds in a zip code, say 5 or more single-family homes in 90 days, filed within a week of closing. Add a municipal notice of intent to bulk purchase for portfolios over a set size, with a short cooling-off period that allows community land trusts, nonprofits, or resident groups to assemble competing bids with public support. It's not a veto, it's a window. Pair it with right of first offer for tenants when an investor-seller exits a small block of homes, with financing assistance through mission lenders to make the offer real. Build-to-rent can serve families without starving the for-sale pipeline if incentives point both ways. Where localities zone for BTR, condition approvals on mixed delivery. A portion of lots must be sold to owner-occupants or to nonprofits for affordable resale, with deed restrictions that preserve starter stock. Offer expedited permitting and impact fee reductions in exchange. Builders will take certainty. Cities should take diversity of tenure. Now the capital markets. SFR securitization shouldn't be a black box. Requires standardized reporting on pools. Rent growth by vintage, fee income share, maintenance spend per door, delinquency, eviction filings and outcomes, and resident tenure. Mandate disclosure of loss mitigation policies. Rating shops should weigh pro-tenant practices positively, flexible partial payments, reasonable late fees, low eviction reliance, because they correlate with stable cash flows. Tie issuer eligibility to basic consumer safeguards. Compliance programs, hotlines with tracked resolution times, and independent audits of fee disclosures. Eviction data needs daylight. Enact statewide reporting of filings and lockouts by owner entity, property type, and zip code with quarterly publication. Flag outliers for enforcement review. Prohibit blacklist, use of filings without judgments in tenant screening. Require landlords to offer payment plans before filing and to withdraw cases upon cure to keep records clean. Eviction is a metric. Regulators should treat it like one. Zoning reform sits upstream. Legalize small lot. Single-family, duplexes, and ADUs by right in more neighborhoods, coupled with pattern book plans to cut soft costs. Where neighborhoods fear speculation, pair reform with anti-displacement tools. Tax relief for long-time owners, repair grants, and down payment assistance targeted to locals. More doors, more tenure options, less pressure on any single rung. Enforcement must match algorithmic speed. Stand up state housing enforcement units with APIs to accept tenant complaints, auto-triage by severity, and push alerts to landlords with deadlines. Fine schedules should escalate for repeat offenders with public scorecards. Offer compliance pathways, template disclosures, model leases, mediation programs, so good actors move fast and bad actors stand out. Don't forget carrots. Create resident stability credits for landlords who keep renewal increases below a set benchmark, maintain low eviction rates, and meet repair SLAs. Credits against property taxes or transfer taxes when selling stabilized portfolios to resident-first buyers. Align returns with stability, not churn. These aren't silver bullets, they're torque wrenches. They tighten specific bolts, pricing clarity, repair speed, fair collections, transparent capital, and mixed tenure supply. You won't end the rent machine with rules. You can force it to share its efficiencies with the people who live behind the doors. The crisis point, where this heads if nothing changes. Follow the math forward, and the picture gets brittle. Rent keeps taking a bigger slice of paychecks, and families trim everything else. Childcare corners, medical appointments delayed, retirement contributions skipped. The rent-to-income ratio doesn't have to break records each month to do damage. It just has to sit high and stay there. A budget that can't flex stops absorbing small shocks. One car repair and the dominoes wobble. Household formation slows or shifts. Couples delay marriage, postpone having kids, or move back in with parents because the security deposit plus junk fees wipes out savings. Birth rates drift down as housing eats the space where plans live. Neighborhoods see fewer long-term bets, less coaching, fewer block parties, less volunteer time, because temporary life makes people act temporary. When staying put costs more each year, commitment thins. Schools feel it in ways spreadsheets miss. Rental churn jitters enrollment, and districts that set staffing in spring discover empty desks in fall. Funding formulas trail reality by a year, so a handful of percent in student volatility becomes teacher layoffs or larger class sizes. Meanwhile, PTOs built on stable parent networks grind down. The soft tissue of a community, the part that isn't measured, starts to fray. Financial fragility compounds. Renters don't build equity buffers in good times, so downturns hit hard. When layoffs rise, arrears rise, and eviction filings follow. That wave doesn't stop at the curb. It trips municipal budgets with shelter costs, court backlogs, and emergency aid. Landlords see higher delinquency and push stricter enforcement to satisfy bond tests, which accelerates filings. The machine protects itself. Families don't have the same option. Investors aren't insulated either. Concentration risk sneaks in. When the same platforms cluster in the same metros, political backlash doesn't spread evenly. It slams a few markets at once. A city council passes a fee cap or a notice period that stretches renewals. A state attorney general wins a settlement that forces disclosure and refunds. Margins compress. If financing costs rise at the same time, because a few securitizations underperform or ratings tighten, yield gets squeezed from both ends. There's a liquidity illusion baked into the bond pipeline. As long as occupancy stays high and renewal spreads hold, securitizations price fine. But if vacancy blips and maintenance costs jump, insurance spikes after storms, property taxes tick higher, supply chains nudge capex, cash waterfalls don't care about intent. Triggers flip, cash diverts to reserves. Equity holders shout about discipline, and operating teams push harder on fees and timelines. The pressure passes down the lease. Meanwhile, the for-sale market doesn't recover where it matters. Starter inventory remains thin because owners with low-rate mortgages won't list and builders serve known buyers, bulk rental takers, over jittery first-timers. The path to ownership that once required patience now requires a windfall or help from family with equity. Intergenerational divides widen and mobility calcifies. The promise that work plus time equals stability begins to sound dated. Local politics darken. When neighborhoods feel extracted from, they pull up the drawbridge, block new housing, fight duplexes, resist transit. That makes supply even tighter and anchors prices. A feedback loop that started with financing math ends with planning meetings where everyone loses. The loudest voices often have the lowest exposure to rent hikes, and the people most affected can't take a day off to testify. The labor market carries a hidden cost. Employers in growth corridors struggle to staff mid-wage roles because workers can't live near jobs. Commutes lengthen, punctuality drops, turnover rises. Health systems and school districts pay hiring bonuses that evaporate into rent. Productivity looks fine on paper until burnout spreads, and then it doesn't. Cities that rode in-migration run into the wall of housing that won't bend. Now layer climate volatility. Insurance premiums jump, deductibles climb, and in some places carriers pull out. Landlords pass those costs through. Public budgets redirect toward resilience and recovery, pushing taxes up. The same households that couldn't save are asked to shoulder rising base costs. For investors, higher fixed expenses trim net operating income, and the only lever left is price, a puzzle when tenants are spent. At the end of this road, we get a housing system that swings harder in recessions and heals slower in recoveries. Families carry no cushion, municipalities juggle volatile revenues, and investors were the political target that comes with visible scale. A few shocks at once, rates up, jobs down, storms heavy, and the model that prized predictability runs hot. Evictions spike, bonds widen, lawmakers scramble. The people in the middle lose first and longest. We owe the bill now, but the real cost shows up later. Children who change schools every year don't become adults who anchor neighborhoods. Workers who can't plant roots don't build local businesses. Retirees without equity lean on public safety nets. If nothing changes, the rent machine keeps its promise to investors and breaks a different promise. The one that says ordinary effort buys stability over time. Everything before this point has been about understanding the gears. The next moments are about choices. Not slogans, not enemies, rules, tactics, and priorities. Because a future where families rent their futures back 1 month at a time isn't inevitable. It's an incentive structure, and incentives can be moved. The personal stories, micro consequences at human scale. Maria kept her daughter's drawings in a shoebox under the bed. The renewal notice came with a $185 increase and a new community operations fee. Moving meant 2 deposits, a week off work, and another school transfer mid-year. She signed, then crossed out summer camp on the fridge calendar. Darius thought the pet rent was a one-time ad. It wasn't. Each month, $35 for his old Beagle, plus $9 for smart lock access he never used because the app froze. He asked the office. They pointed to the portal. He bought cheaper groceries and turned the thermostat up. Keisha's deposit evaporated into cleaning, filter program, and trash valet after she moved to care for her dad. The itemized list arrived without photos. She called, emailed, waited. When the refund finally came, it was $92. Her new landlord wanted first, last, and fees up front. She borrowed from her sister. Miguel's leak started as a ceiling stain. Work orders bounced between vendors for 6 weeks. He documented everything, then cited the city's repair timeline in a certified letter. The next day, A crew showed and the portal credited half a month's rent. He kept the letter template and shared it with neighbors. Alicia timed her renewal. She gathered 3 listings with lower effective costs, asked for a 24-month lease, and requested a written cap. The manager agreed to a smaller increase and waived the resident benefits bundle. She saved $960 over the year. It wasn't victory, it was oxygen. Jamal and Priya lost 5 offers, then won a slightly tired ranch 25 minutes out. They brought a fully underwritten approval, capped the appraisal gap at $8,000, and offered a 2-week rent back. They painted on weekends, installed fans, and kept a small emergency fund. When their car needed brakes, they didn't panic. Microstory ad. Sonia, a paramedic in Phoenix, asked to pay half on the 1st and half on the 8th. The portal refused partials. An automated notice posted on day 4. A supervisor finally accepted a cashier's check, plus $110 in late fees that month. Home as stability versus home as line item. These are the choices families face. The machine is big. People are not powerless. Knowing the levers changes outcomes at the kitchen table. Resolution and broader meaning. Homes turned into spreadsheets shift risk onto families until stability becomes a subscription paid monthly. If you want leverage, use the checklists and tactics we showed to cut junk costs and win selectively. Do this in the next 48 hours. Pull your lease and create a 1-page true rent sheet. Base rent, all recurring fees, utilities, and deposits. If any item wasn't disclosed up front, draft a written dispute now. Email your landlord for a full fee schedule and a 24-month renewal option with a written cap. Offer longer tenure in exchange for a smaller increase and removal of the benefits bundle. If you're buying, get a fully underwritten approval, not a pre-qual. Set an appraisal gap cap in writing and identify 3 off-market targets, long DOM, small flaws. Set up automatic transfers to a high-yield cash account or T-bill ladder for your next home fund. Treat it like rent due to your future. Join one local tenant or housing group to learn your market's specific levers. Repair timelines, fee rules, and escalation contacts. Then share this with one person who's stuck between renting and buying. The machine is optimized for yield. You can optimize for leverage starting today.